Hi friends, and welcome to another episode of Arctic Money, and we're gonna end the things before Christmas here with taking a look at my risk-reward matrix that I kind of stole from the famous YouTuber, famous investing YouTuber Sven Carlin. I'm sure some of you, my viewers, know him. This I stole from him, and basically what you see on the screen now is all the stocks I'm interested myself that can be found from my watch lists. I have divided them into this risk-reward matrix. Before we get into it, quick explanation to you if you didn't watch my first video when I did this risk-reward matrix. The risk here is company-specific risk and how well I think I understand the company and its industry myself. So that's what determines the risk. And the reward is my valuation on the company, including my personal margin of safety, derived also from risks around the company that I can see. So this is how I constructed this risk-reward matrix so that you know the background to it when we get into it. And I think this is pretty nice visual illustration where you can see what stocks are most close to be buys for me, and which ones are quite far away by their valuation. And obviously, in regards to the reward, there is my valuation that I compare to the current stock price of the company. So if I feel like the stock price is too high, then the reward is obviously small. You get the big picture. So let's get into it. But maybe you're interested to hear my comments a little bit on the overall stock market at the moment. Obviously, I am not a macro expert. Not many people in the world are, and predicting macro is impossible, in my opinion, at least in the short term. But everything I presented in this video is obviously my own opinions. You need to do your own research. You know that every time. But if I may, I would like to say that overall, I find that the overall market is not cheap at the moment. For me, it's getting harder and harder to find good deals all the time, as many of the companies in my watch list have gone up in their stock price, actually, quite recently, as many stocks have. I feel like Standard & Poor's 500 is most likely overvalued or fairly valued at least. It's getting really hard to find good deals from there, in my opinion. Of course, I haven't made valuations on every company in the S&P 500, but I do follow many colleague YouTubers and their valuations, and many wise people who have things to say about the market. And what I can interpret from everything I see and hear, my own feeling based on this is that Standard & Poor's 500 is more likely to be overvalued than undervalued at the moment. Commodities can be interesting. Obviously, they work kind of as an inflation hedge, as you know, and I feel that commodities, again, same thing, what I've been reading and seeing and hearing other people say, commodities are not per se cheap at the moment, but some of the commodities may be approaching levels where they can be interesting, and maybe you should start your research on some commodities. For me, for example, if you're an Arctic Money viewer, you know my position. Uranium is my biggest position, and I have seen 70% gains this year with my uranium positions, Sprott Physical Uranium Trust. So uranium has done absolutely amazingly. I haven't sold any bit of my uranium, to be honest. Right now I'm thinking that when I will start my selling program, when uranium spot price hits $100, that's about the range where I see that I want to start my long selling program. This means that I'm not gonna empty my whole positions in my two uranium investments, one ETF and then Sprott Physical Uranium Trust. Not gonna sell everything immediately, but I am going to see hopefully the spot price go up even from 100 and continue selling bit by bit until there is nothing left, and then we move to other things, hopefully. Obviously, we'll see if that happens. I feel confident still in uranium, as I said. But nevertheless, this video is not about uranium now. Only we were talking about commodities. Uranium, obviously interesting. Other commodities that you should probably be a little bit exploring at the moment is oil. For me, at least, it's oil. Then it's copper. I've heard some talk about lithium being cheap for the first time for a very long time. So lithium might be one that I might take a look myself next. Haven't decided yet. Nevertheless, I encourage people to look at commodities too, and companies playing with commodities. Then I want to say that small and medium cap companies compared to large caps, I think there are more deals to be found in small and medium cap space at the moment than a large cap. I would look also rather deals in the UK and Europe right now rather than North America. As I said, I feel North America is pretty well priced in. Emerging markets, especially China, come with great geopolitical risk that sure all of you know. But if things and sentiment change for the better, only in my Alibaba investment, I can see that Chinese market offers huge bargains at the moment if things develop well. If not, you know that there is a risk of your Alibaba and other Chinese positions going to zero. You need to always keep that risk in mind when you position yourself, but I still feel hopeful myself that things could improve for the better, and Alibaba still is a big part of my portfolio today, even though I have taken pretty big hits, and that has been the worst investment in my portfolio for the last 5 years, but somehow I still feel that the story is still developing, and like to stay optimistic myself in spite of some harsh rhetoric from Chinese governments concerning obviously Taiwan. I hope sense will reign, and this is more about politics and China wouldn't do anything as stupid as Russia has done, and I want to be optimistic about the world that bit, even though there's hard to find any optimism in what Russia is doing, and just hoping that there is no other country in the world that is as stupid as Russia. And that's about it, my macro thoughts at the moment. So let's get into the risk-reward matrix and what we can find there. So first, let's start from the top right corner, where you can see companies that are high risk, high reward, in my opinion. Obviously, I already touched Alibaba here, so let's not talk about that too much. Only thing I can say is that is what I already said, that if things move for the better, sentiment gets better, and the relationship between China and USA gets better, Alibaba presents huge rewards, but as I already told, it comes with huge risks at the moment. So position yourself accordingly is everything I'm gonna say. Then there is flow traders, also a big part of my portfolio, liquidity provider in the markets. High risk profile because fintech is not where my expertise mostly are. I have been reading and trying to learn it a lot, but I couldn't say that flow traders is the one I feel the most confident about. That's why it's high on my risk profile, but also the valuation seems pretty good still, so it may offer big rewards. Obviously, if there is big turmoil as it happened with Corona crisis, when Corona hit the world, flow traders might explode as a stock. It's still a possibility when volatility picks up. So it kind of has that hedge role in my portfolio still. Then you have Geo Group, Core Civic, they're private present operators in the United States market. Their stock prices have gone up and they are massively on the green side in my portfolio at the moment. Still holding on to them though. They carry the risk of being this very unique industry where government has lots to say how this business obviously do, as you can imagine, but they are providing services, for example, for the crisis at the southern border, with the immigrant crisis at the southern border of United States. Geo Group, Core Civic are assisting in that, and that crisis, as far as I can see, is not going anywhere. It's continuing, and it is hard for me to see how Geo Groups and Core Civic services wouldn't be needed by US government, so that's why I'm still invested in those. Uranium, we already talked. spot price plus 70% in 2023, so huge gains in my portfolio. Still not selling though. It's a commodity play, so the risks come from there, and not anymore so high in my obviously in my reward scale as the price has seen. The spot price of uranium has gone up hugely, the best performing commodity in the world this year. So of course, when the price goes up, reward goes smaller, as you can imagine. Then you can see the circle of companies there, and actually there are Eurofins, laboratory services provider, then there are Carriage Services and Park Lawn Corporation, two funeral home and cemetery operators in North America, Tyson Foods, biggest meat company in the United States, and Amsterdam Commodities, trading business from Europe, trading spices and nuts and all sorts of flavor stuff. What do you have there? Go and check my Amsterdam Commodities video. This group presents to me okay reward, low risk companies at the moment. They are all in my portfolio actually. Although they are small, relatively small, some of them medium-sized positions in my portfolio. But overall, if you are looking stocks to buy right today, I would research these companies at the moment. None of them is amazingly cheap at the moment. None of them is that. But I think they are all quite fairly to undervalued at the moment, and present to me companies with kind of strong moats, good positions in their own respective industries, good niches, what they do. So that's why I have them low on risk scale, because I think they are stable companies in stable industries that will always be needed. I'm sure of that. And if you're looking for an okay investment, I'm not saying safe investment, because there is no such thing as safe investment in the world, but on a safer side of things, let's say this is the group of companies I would be looking at if I may suggest anything. I know many people look in YouTube for stocks to buy. I don't think there are stocks to buy. There are long times when there are no stocks to buy in the world, as everybody who has been checking Warren Buffett, Charlie Munger knows. There are always good bargains on the market, you just need to find them, but it is completely okay to stay in cash for long periods of time. But if you have huge amount of excess cash, if I were to have a huge amount of excess cash at the moment, which I don't, I would be looking at some of these companies, to be honest, to invest my money today. So for those ones in YouTube looking for stocks to buy, I guess you can take a look at these and start doing research on these and find out what you can find out. But to me, these represent the best group of companies in my watch list, in my risk reward matrix here. Then let's move closer to the cross section, where we have Dr. Martens, a new company since the last risk reward matrix, and Greg's also a new company from the last time I did this risk reward matrix. Dr. Martens and Greg's, obviously two UK companies. I was interested in looking at the UK stock market here post-Brexit, and as it has done pretty badly the recent years, and see if there is something interesting. And I found these two. Dr. Martens obviously known for their shoes, their boots, and Greg's is the biggest fast food chain in the UK market. So interesting companies. If you're interested more of these two, go and check my videos on them on my channel. But have to say, they are not quite there yet where I would like to own them, but they are not too far away from it, either of them. So their stocks, at least Dr. Martens stocks, has nothing but gone down since their IPO. It's not too far away from where I start buying it, and neither is Greg's. These two I would like to see in my portfolio, because then I would have UK companies for the first time in my portfolio. Then we have also a third one there on the better reward side, which is Alphabet, Google, as you know. From the things I have been following in the Magnificent Seven space, I have on my valuations, I have on Microsoft, Alphabet, and Meta. And out of these three, and what I can hear from other people's valuations and opinions on also the rest of the Magnificent Seven, also Tesla, by the way, that I have two there. I think Alphabet, Google presents the best risk-reward opportunity at these levels, at these prices, but still, as Greg's and Dr. Martens, still not there for me to start buying. I have been owning Google previously, actually a couple of times even during the last 5 years. But to me, Alphabet is the best out of, if I was forced to buy one Magnificent Seven stock today, that would be Alphabet. So those Dr. Martens, Greg's, and Alphabet are not too far away from the levels where I would like to become owner of those companies. And that's that. Now we move to the left side of that reward matrix, where we have the companies that are more far away from my buy prices. First up, there's Disney. Great company with great moat, high on the risks, or rather higher on the risk side, mainly because of the Disney Plus streaming wars. That's a nasty industry with nasty dynamics, in my opinion, and presents risk for Disney also. Other than that, their amusement parks, the brands that the company has, amazing business with moats. I have owned Disney before and would like to own again, but as the company is trading somewhere $90, that's too much for me. Were it to hit $70, Disney would be back in my portfolio. We have also there on a little bit better reward side with actually really low risk, in my opinion, General Dynamics and Lockheed Martin, two military technology companies from the United States. The sentiment in Europe, at least due to Russia's unlawful attack on Ukraine, has changed for many years to come, and it's clear that Europe needs to invest in its defense, and these companies stand, in my opinion, to benefit from it for the years to come. So I would like to definitely own these two big military technology companies. Their valuation is not sky high, in my opinion, but definitely not at the levels where I would buy them now. They need to come down also for me to become owner of those. But to say if these companies were to somehow unexpectedly see a decline in their stock price, and the same goes definitely with Meta, Berkshire Hathaway, and Microsoft, if any of these group of great companies of the world would see a sudden crisis and stock price plummeting, I would definitely be a owner of these companies, and hopefully for a long time. Great companies, as everyone knows. We can talk Meta. Obviously, I was buying Meta at 180 to 100, made good nice profits with it. I sold again at 190 everything. We all know Meta has gone up a lot more since, but that was a great learning story. What happened with Meta stock price a while back, and how markets can be really irrational. Still a great company, in my opinion. Let's see if I own it again at some time. I already, in my opinion, out of my watch list, Berkshire Hathaway, Microsoft, the deepest moat companies out of all in my watch list, the best companies of the world. Nothing wrong with them, absolutely nothing, but their stock price at the moment, the valuation, I just don't see it. They are too expensive, in my opinion. Then we have their group of, let's say, low risk, but pretty bad reward due to their high stock prices. Intel I used to own, but sold already. Intel has a role in the chip wars. It has national security interest for United States, also Europe. That was one of the reasons why I invested in it in the first place. It goes to the same group actually. There's a few companies that are important from the national security perspective for United States. I would say Intel, Microsoft, Alphabet, Meta, General Dynamics, Lockheed Martin, they belong to this group. And when you have US government on your side and kind of needs you to succeed, I think that's a moat thing. And those are kind of companies you like to own in your portfolio, because any of these companies failing would also mean pretty bad things for US economy, US national security, also Europe in a way. And let's just say that it's nice that government is cheering for your company. That's my theory. You might disagree. If you disagree on this, please let me know in the comments, but that's how I see these companies. Then we have Service Corporation. That's competitor of Carriage Services and Park Lawn, so funeral home and cemetery operator. For some reason, I'm just ending up with hugely worse valuation than these two smaller ones. I think Service Corporation is really overvalued, but Carriage Services and Park Loan Corp are at least fairly valued or undervalued at the moment. Starbucks, a moat company. Everybody knows Starbucks. I think their history, how they have such a strong brand, people just want to drink their coffee no matter how much does it cost, basically. And it's a great moat company, in my opinion. Would like to own it. Not too risky, even though there are competitors, obviously, in all retail businesses. But again, it's a matter of valuation. Ulta Beauty was actually trading a lot lower, not long ago, but the stock price just recently has gone up a lot. I was already eyeing that should I start a buying program of Ulta Beauty when it was dropping the stock, but now it has again went to the levels that it's not even basically near where I would consider buying it. Still, their loyalty program, the company, how well they have done in spite of companies like Amazon competing basically with them and many others also. There is something very moat about Ulta Beauty and their financial results, and I can see that, and that's why I'm so interested about this beauty company selling beauty products. If some of you, my viewers, don't know what Ulta Beauty is about in the United States market, and now I'm not sure if they are. I think they are not in Canada, but only in the USA. Moving on, still on this lower risk side, we have Manchester United. Surely everybody who watches football, knows sports, know what Manchester United is about. Why? Some of you might obviously, I think, hugely overvalued company. I wouldn't touch it myself, and the football business with a long stick even. I don't want anything to do with it. There is one caveat to this, and this is if financial fair play rules in European soccer, football, whichever you are watching this from North America or Europe, I'm gonna say football now. If the financial fair play rules were to change, that would change the dynamics of the industry completely. For me, it's difficult to see that they actually would change drastically to look like more of a North American sports, where actually North American sports team are making money for their owners' profit in Europe. That really is not the case with sports, and sports. When you shouldn't probably be comparing Manchester United to Starbucks, Meta, Ulta Beauty, or Disney. You should probably be comparing to churches or non-profit organizations, because I think the football industry is closer to communism than open competition with corporations, to be honest. But that's, if you're interested in football, you can find football and economics videos on my channel too, so go check them out. I have Soccernomics, summary of the book Soccernomics, a great book on football. Go watch that video. It was really fun. I had really lots of fun making it. And I also have Manchester United video, so go check that out if you are interested more about Manchester United. But even though there seem to be many billionaires wanting to buy Manchester United at the moment, I wouldn't like to touch the company, the football club, even with a long stick. And I'm not even taking into account the fact that I'm a huge Arsenal fan myself. I try to keep emotions away from investing. I might become a Manchester United investor and still a cheer for Arsenal, but with those valuation levels, Manchester United has not a chance. But I'm not sure if I answered my own question, but why is Manchester United this low? Some of you might think it's lower risk than Disney on my risk scale. The reason is that Manchester United is one of the biggest brands globally in the sport. They have huge brand moat, and that's worth something. That's the reason why they are low risk. Then moving on, we have Spotify. Great product, great company, valuation is sky high, and something I have been reading about Spotify is that they have, I would need to recheck this, I'm not completely sure, but I think they have huge stock-based compensation. It looks like the company is run more for the owners or the founders of the company than shareholders, and or something like that. This I remember reading one article which sounded kind of alarming. I didn't look more into it because Spotify is not close to the levels where I would be interested in it. But when you think Spotify is close to your valuation, where you would like to own this great company producing a great product, I couldn't live without my Spotify account. I suggest you take a look at their stock-based compensation, and and you need to build scenarios when the company is actually becoming profitable, which is not. You need to see how that profitability becomes reality and build your valuation from that. Definitely not an easy valuation to say. Then we have Harvia, a Finnish sauna and spa company from the Finnish market, Helsinki Stock Exchange. Very hyped up stock throughout the last 5 years, 4 years, let's say. Wild ride with the stock price, and I wanted to take a look at it myself. It's trading somewhere around 24, 25 euros at the moment. I remember when I did my valuation on Harvia, I would become interested in it below 10 euros per share. 8 euros I would have been definitely buying it. I can't remember. In the most lowest point last year, I think Harvia dropped to 12 euros per share. After being 70 euros or something completely crazy when you had the Corona stock market craziness going on, but now I think there's something exotic in it when it's a sauna company from Finland, and Finland is known for their sauna culture and stuff like that. But I try to look at the valuation, try to look at what kind of economic landscape is lying ahead, for example, new constructions and building industry, and I see kind of risks with Harvia, and that's why I think the valuation is way too high today. We'll see how that story continues. Then we move to low reward, high risk situations, so companies not near my bias. There is Crocs, the company I used to own and buy when it was something around under $50 or something. I made great profits in 3 months 2 years ago with the company. Very good company, very good products, and but the valuation is wild, and you need to look for those stock market goes crazy moments with Crocs. When the company was trading under $50, I could see that it was hugely undervalued, and that's why I bought it. Obviously, why you are interested, why it is high on the risk side. Fashion is, as you can see, Dr. Martens, Crocs, Victoria's Secret there. Fashion is difficult industry, lots of competition always, and that requires a higher risk profile for me every time I would like to invest in fashion industry company. I have done it with Crocs already, and I might do it with Victoria's Secret or Dr. Martens too. I might invest in these three, but yeah, that's they really need to hit my valuations, and I'm being quite careful with margin of safety with these companies. And Dr. Martens and Crocs, I perceive them to be a little bit better. Actually, Dr. Martens, if I remember correctly, has really low debt levels compared to Crocs and especially Victoria's Secret. So Dr. Martens is the one I'm eyeing the most out of these three fashion companies. Now, Victoria's Secret, huge debt pile. The debt definitely is a problem with the company, is a big risk with the company. That's why it is a risky investment. It went down 6 months ago, and I got interested in Victoria's Secret. I also saw that Victoria's Secret was a company making profit, but still quite heavily shorted. So there was a possibility for a small short squeeze, and I think the short squeeze actually might have happened, because if you look at Victoria's Secret stock price, it has gone up hugely recently. Go and check that one out. I haven't checked what the short position, short percentage of float is at the moment with Victoria's Secret, but wild stock if you want to take a look at it. Go check, if you're more interested, go check my video on it. It's a risky investment, but it's high reward, high risk, definitely. In a competitive industry, obviously, but they still have they became quite a big of a brand 10-15 years ago, and that brand mode was something I was still interested in myself. And let's see, their CFO was buying the stock something like 6 months ago. After that, the stock went down quite a bit, but after that it went up much more hugely, so the CFO made money with it. Probably the CFO, it seems like he knew what he was doing, and you shouldn't trust any one individual's opinion ever, not me talking here or not one CFO or CEO or any one insider. But for me personally, when I see CFO or CEO buying company stock from the open market, that piques my interest. And in this case, the CFO of Victoria's Secret seemed to know something that was about to come, and the stock price went up hugely. And finally, we have Tesla. I have videos on Tesla on my channel, and you can go and check them out. I think Tesla makes great products, Tesla makes great cars, the valuation is sky high, and the numbers don't justify the valuation, that's that. Also, there is competition coming at them for sure. Tesla is not alone in the auto industry, and yeah, you have what they do, robots, they do robo-taxis and whatever. That's obviously, if they take market like that, probably the stock will do really well. But these are high risk bets, and they either happen or they don't happen. One thing's for sure, other companies in the industry will not leave Tesla alone and just let Tesla win the battle. So I think the competitive pressure of Tesla will be high, is already high and will be high. I have made valuation on Tesla too. I even presented the price where I would start buying Tesla stock. Go and check that out from my old videos. I haven't updated them since. Actually, as the year end is here and companies start publishing their full year results, you can expect at Arctic Money me making updates on these companies. If there is something to update, I will surely drop probably, if not all, most of these companies for sure. I will drop you a video and update my valuations and views on the company. If there is something to update in their outlook for the future, how I see it, and obviously the stock price compared to my valuation, I will update my valuation and see if something has changed. So if that kind of content interests you, hit that subscribe button, and I will thank you for it. I hope you enjoy this kind of video. This is basically my watch list. This is the work I do for my personal investing. You need to always do your own research on these companies. I only hope that I can help you find interesting companies in interesting industries, and then you can start making your own research on these companies and see whether they are those famous stocks to buy for you or not. And that's what I encourage everyone to do. That's what I require every one of my viewers to do. You always need your own valuation. Never trust anybody else. Your own valuation is essential every time. But yeah, here is my watch list basically put into the nice risk-reward matrix. I already told you that those companies inside that circle are the most interesting ones to me at the moment. And let's see, when the stock prices change with these companies, they move around this risk-reward matrix naturally in the future. I will drop another video after some months, probably again doing this risk-reward matrix for you. But until then, thank you for watching this video. I hope to see you in the next one, and Merry Christmas. Bye bye.